I think there are a lot of things on the horizon that are impacting the level of confidence among both business people and lenders as well. Not only the election in the United States, but the fiscal issues that our own government is facing, but also the issues that Europe is dealing with. And I think from a banking standpoint, it's going to be a while before the Europe issue works itself out. And so I think the banks will continue to be a little skittish until Europe gets their whole issue worked out. I think on the business side here in the U.S., once the election's over, I think businesses will have a little more clarity in terms of which direction the country's going, and I think that will help confidence improve here in the United States.
Despite the news coming out of Europe and the persistent negativities, I would actually point to several bright spots in the economy. Business investment has been very strong. Corporations have retrenched themselves and actually have significant liquidity and very strong balance sheets. As a result of that, we've seen significant increases in business travel, or resurgence of business travel. And what that means for the hotel business is, our demand for our product has actually been growing at a steady pace despite the ebbs and flows of economic growth around the world. So I would actually say this is a good time to be in the hotel business because overall operating fundamentals have been improving. We are almost back to peak occupancy levels. And now what we're starting to see is more and more rate growth. So again, despite what we've seen in parts of the economy, the hotel business, while not demonstrating white-hot growth, has been demonstrating fairly strong growth.
I sure hope so. The biggest challenge in business is uncertainty. And I think we need to get through the election before there's a good growth that we all would like and expect in the future. But in spite of that, there's still opportunities. There's still ways to get projects done. The right projects will still get done, both from an equity standpoint as well as a debt.
I do. I think, especially in our business, I think there is an optimism that with the election behind us come the end of the year, I think there will be a lot more certainty in the business. And so I think there will be a lot of optimism going into 13, and I think now, especially into 14, I think there's going to be a lot of optimism.
Clearly, there's confidence returning among bankers and developers, although it'll probably be a slow thaw. I wouldn't expect that we're going to see an avalanche of new development anytime in the foreseeable future.
I think there is greater confidence amongst not only the people in the industry, but all the people we depend upon, the lenders and developers. The fundamentals just keep getting better. And as long as the fundamentals look strong, I think we'll continue to see better confidence in the business. Lots of things out there that can sidetrack us, but right now it sure feels like the fundamentals are in place and going to stay there.
We do see overall confidence coming back. It's rather interesting because, yes, there have been still some bumps in the economy, but I think there is a renewed confidence level in general that people are optimistic. People want to see the economy get better, and as a result of that, I think the lending institutions are also, gravitating to having a little bit more flexibility for deals that I think show a greater degree of success.
Well, believe it or not, with all the headwinds that we are hearing in the media with the economy not doing so great, the fundamentals within the lodging industry are strong. We are seeing high demand. Within the industry, we are selling more rooms year to date than we have seen in the 20 plus years that STR has been tracking data. We are also seeing strong growth among occupancy and average daily rate and relatively low supply growth. So with that said, I would think that the overall confidence from the development and lending community should be moving in the right direction, even with the elections coming up and with some of the turmoil that we are hearing about overseas, so on and so forth.
Well, actually, we do see some confidence. There is some money available for the right projects. For sure, in the U.S. and traditional Europe, financing is difficult. But, we've found our way. For example, we're opening a new hotel in Amsterdam. Amsterdam needs a luxury hotel, and we're able to figure out a package that was financeable. We also have found a lot of opportunity on certain conversions. of properties that are luxury properties, but can be kind of reassembled in the right way with the right economics. So yeah, there is money available, but it's still still you have to kind of dig it out.
I wonder if I'll sound contrarian, but I really do see a pickup in lending activity, not just in the recent 2 or 3 months, but in the coming 2 quarters. And I think what's driving the lending community today is a sense that we've been addressing the same economic risks, and perhaps we have factored in many of those downside risks. At the same time, we're seeing fundamentals continuing to grow, albeit not at a pace that we would dream for, but at a very steady pace to suggest that those in-place cash flowing assets are finding debt yields and interest rates and loan to values that we find very compelling. It has been the single biggest surprise and determinant in some of our acquisition activities in the last few months.
My personal belief is that confidence has already really returned, and without a lack of confidence, or with a lack of confidence, you would have no transactions at all. So the investment community and the lending community has determined how markets are going to perform going forward, and are confident enough in that they're willing to transact. So I will say that we're not looking at exponential growth numbers for North America in RevPAR, and I think that everyone is underwriting fairly conservatively that we're going to have slow overall RevPAR growth after the the adjustments that we've seen in 2010 and 2011, partially 2012 with a little bit higher recovery rates, but. Looking past the next couple of years, I think everyone's considering sort of 3% and 4% and 5% RevPAR growth, so relatively low. But that said, I think everybody believes that there is going to be that type of growth, and accordingly are willing to transact.
I think confidence has been coming back a little bit. Confidence hasn't. We had 3 or 4 rough years, and we're coming out of that. So confidence has been coming back slowly. We've seen it as demand has increased, and so the metrics at the hotels have been pretty good. Occupancy's been going up, and we haven't been getting the rate coming back the way we'd like to see it come back. But as the demand grows, we've seen some gains in that area too. So confidence feels like it's coming back. The difficulty is, I think it's still, everyone's memory is still too recent on all the pain, and the pain hasn't ended yet. There's still a lot of properties that are in financial trouble or underwater or over leveraged, and those have to all play out. So I think until those play out, people won't be completely confident.
I think for the level where we compete and the assets that we own in urban, upscale hotels and upscale hotels, I think it's going to be a while until construction financing comes back in a big way. I think banks in general are a lot more particular in terms of the assets that they'll lend on. They want stable sponsorship, stable assets, and I think it's just that financing is going to have to come back in a bigger way until banks really want to take the extra risk for construction financing. So I think new supply growth is still a ways off.
No, I don't see capital being allocated to new hotel development. Hotel same store earnings are still at a point that don't justify new development. So very difficult to get a construction loan for larger properties. It just doesn't pencil from both a debt and equity perspective. And so for the time being, I see most hotel owners focusing mostly on acquisitions or selling assets.
It's a capital market process. Right now, it's obviously easier to get debt on a performing property for an acquisition. We are also still doing new construction, and they can be done if they're the right location, again, the right project. We do need, the new construction will happen when the replacement value is much more expensive to acquire property than it is to build it. And that will come soon, and debt will have to loosen up as well.
I think most of the focus will be on acquisitions and conversions for the next year or two. New development is being done in the right markets. We're active developers in certain markets, in the right markets with the right brands especially. You can get backing, for the right project in the right market, but the widespread development is still, probably a couple of years off.
In our case, at least half of our new development is new construction, but I don't think that's the industry trend. I think we're somewhat unique in that sense.
There's always going to be places where new construction makes sense, but I really think it's going to be the unusual occurrence. It's not going to be the norm for the foreseeable future. I still think repositioning existing assets or redeveloping product is going to be the biggest strategy for our business for the next few years.
I think new construction really comes down to a market-to-market type situation. There are some cities where new construction is absolutely impossible, where the barriers to entry are certainly very, very high. But again, I think the savvy developers are out looking for redevelopment opportunities. They're out looking for new acquisitions, and on a very, very select basis, I think you're going to find some new development, ground up scenarios happening.
We are. Actually, STR looks at the hotel pipeline, and we track what we call the active phases, which includes in construction, final planning, and planning. And in our in construction and final planning, we are seeing growth year over year. So in the in construction phase, that is up 12% versus July of last year. And in the final planning, it's up 35%. So what we would assume is, although we are not suspecting a huge amount of new supply in construction or new growth in 2012 or 2013, we probably will be having some new supply conversations in 2014 and 2015.
You'll find that again, the majority of what we have done, we are the fastest growing luxury hotel company right now. The majority of what we've done is conversions. But I will tell you, please stay tuned over the next several months. We will be announcing 2 new build opportunities that we're currently putting together. So the opportunities are out there, but again, it's in kind of select markets with very special projects. But right now with the supply in the U.S. is totally flat, and what will come is, with demands rising and occupancies getting closer to, for the category, closer to 75%, you will begin to see new build opportunities again with those economics.
I think acquisitions and conversions is still going to be the way to go. New development is really dependent on debt, on lending. And the lenders just quite aren't there yet. Lenders are struggling to come back to the market on existing assets that have cash flow. So new construction is very, very difficult. Now, every market's a little bit different. The top markets, you look at where the supply growth is. In the New York cities, you can talk to lenders about, doing construction debt, and they'll talk to you because the dynamics are all good there. But generally speaking, I'd say we're going to stay in this, buy existing assets, and do repositionings and changes. I think cash is king, and people want cash flow. I think new development is tough.
The development question is a hard one in this economy. I would argue it's less about available debt and more about available equity in the face of other competing alternatives for hotels. What I mean by that is, in certain markets, we continue to develop. We're building a Hyatt in Union Square in Manhattan. We're building a Hampton in Manhattan. At the same time, most of our other markets, we can buy below replacement cost. And so I would argue that we could get outsized returns by acquisition in most of the markets. And though lenders will make construction loans available on a select basis to the best sponsors, I don't think it would make economic sense in many of those markets.
That's a good question. And again, developers will develop and lenders will lend based on their sense that there's going to be a market for their product and relative security in their investment. So when you consider market RevPAR performance going forward, when you get to a point where that's going to yield occupancies and average rates that support new construction, it'll happen.